This year has been absolutely terrible for a lot of the big tech stocks, the Magnificent Seven, with Microsoft down 17%, Amazon 13%, and all of them are pretty much underperforming the S&P 500, largely due to some fears around capex spending. And I think there's a lot of fear, a lot of misinformation. A lot of investors are scared that those stocks maybe will never recover because capex will keep on increasing every single year. So maybe Amazon will not recover, or Meta or Microsoft, they will just never go up again. Or maybe they're going to get re-rated much, much lower, as now they are capex heavy companies. And I believe this fear is generally overblown. I personally disagree with it. I'm going to tell you why. And this is why I'm putting my money where my mouth is. Prior to 2026, I only used to own Amazon. Now I own Amazon, Meta, and Microsoft. I'm going to talk about it, and I'm going to explain my perspective on capex. But again, I believe the fear is overblown. And this is a chart showing the total return of companies that spend a lot on capex versus companies that spend very little on capex. And the one that spend a lot, according to this chart, have massively underperformed. And none of this is true, by the way. And I'm going to go show you some numbers. Now, out of the big seven, the one that spends the most on capex is Amazon, by far. Amazon has always been, you could say, a mega cap or large cap startup. They spent 100% of cash from operations on capex, and this is how Amazon Web Services was born, and this is how many of those services were born, out of throwing out ideas in capex. Some of them worked out, but some of them also didn't work out. But once it does work out, it could change the entire future of the company. And imagine Amazon without Amazon Web Services today. But if we don't even talk about that, just looking at the free cash flow, it's been all over the place, 1 to 2 billion for many, many years, since 2005. It has recently expanded, and now it started to contract again. Now, if we look at how Microsoft stock has performed in this period, Microsoft stock is up 6,596%. Despite the company spending so much on capex, the stock is still up 6,000%. And this is not due to any multiple expansion. If you look at the price to operating cash flow multiple, in fact, it has contracted from about 17, 16 times, 24 times even, now trading at 15 times operating cash flow. Yet Amazon stock has returned 6,596%. Now, I'm not a big believer in the notion that stocks tend to follow earnings per share over the long term or free cash flow per share over the long term. It really depends on the multiple. It depends on the sentiment. It depends on buybacks and dividends. It depends on so many things. But this is an amazing chart of Amazon stock, which this is Amazon, and the blue one is cash from operations. And you could see there's a very close correlation between Amazon stock price and its cash from operations for the company. Despite the company spending a lot on capex, the stock has performed really, really well due to the company growing in cash from operations. So this is an example of a stock that has been spending on capex forever, yet the stock is up 6,500%. Now, this study shows an example of high capex companies and companies that don't spend on capex. Well, this is an amazing example of Meta and Visa. Meta is a capex heavy company, but due to the capex, Meta is growing 24% in revenues. Visa cannot spend a lot on capex. They can't do acquisitions. They can't really do a lot of those things, which is why a lot of those companies have very little capex, and they spend 100% of their free cash flow returning it through buybacks and dividends. But those companies, again, because they can't spend on capex, they're very limited to how much they're growing in revenues, earnings per share, cash from operations, free cash flow per share, etc. And if you look at the performance, Meta is up 144% over the last 5 years, while Visa is only up 53%. And that was not due to any multiple expansion. In fact, the multiple has contracted from over 50 times to 21 times earnings over the last 5 years. So there is a pattern here where those companies have been spending a lot on capex. This is nothing new. They've been doing it forever. Yet those stocks continue to outperform a lot of the companies that were capex light. Why? Because this capex has led to growth. It has led to revenue growth, led to cash from operation growth, and the company has grown in general without the companies experiencing a multiple expansion. Okay. Now, I believe this is due to a reason. And this reason is a lot of the market participants that they know that this capex is not permanent, or I should say it's not 100% maintenance capex. For example, a company like Google is spending $180 billion in capex. You have two kinds of capex. The first one is maintenance capex. This is a capex that the company has to spend every single year to maintain their operations. It could be in infrastructure and maybe semis and other kind of purchases. Okay. The second one is gross capex, which the company can cut back on any time, and they can pretty much maintain the business and they don't need to spend it, but they're spending this capex because they want to widen their moat and because they want to accelerate growth and invest for the very long term. Okay. Now, looking at Google, it's spending 180 billion in capex. But if you look at the business model of Google, and let's assume Google cuts the capex by 50% tomorrow, so they cut it by pretty much $90 billion. Okay. If Google cuts its capex by 50%, do you think Google business would still be here? The Google search? Do you think people will still use Google search? Of course. Do you think YouTube would still be here? Does YouTube need $90 billion or $180 billion just to maintain it? Of course not. It's capex light. I'm doing the work for YouTube. I'm working for YouTube, and YouTube is paying me a share of the revenues. This is one of the most capital light businesses in the world. It doesn't require 180 billion, not even 90 billion, not even 50 billion in capex to sustain it. It's the same thing with the ads business that just goes on top. Same thing with Google Play. Google Cloud is a capex heavy business, but most of it is not maintenance capex, it's gross capex. So if Google decides to focus on the short term, or maybe the stock is under pressure and a lot of investors are pressuring Google to cut on capex, Google decides to cut it by 50%. You think the business will survive? Of course. You think the business would still be growing? Maybe not as fast as it is right now, but you think it would still be growing 10 or 11%? The answer is yes. And this is why I believe those companies like Amazon, like Microsoft, like Google, like Meta have done really well. And they've been spending on capex for years, especially Amazon, which they had many years of little to no free cash flow and some years negative free cash flow. Yet the stock has done really, really well because analysts know that this is not maintenance capex. Most of it is gross capex, which they've been finding growth out of it and they've been growing faster, but they can also cut back on this capex anytime. So a lot of it was pretty much noise. But if you take the example of Amazon, this is what the CEO of AWS said just a few days ago. He said, even with all this investment, my best estimate is that we will be capacity constrained for the next couple of years. Even though they're spending 200 billion, they're still gonna be constrained in capacity. He said, we will sell every single server and every single bit. We will wish that we had more. And this was 200 billion because only 20% of workloads are on the cloud. So those companies are seeing an amazing opportunity in terms of Microsoft and in terms of Amazon, even Google and a few other hyperscalers. This is the time to be spending for the long term. And a lot of it is front-loading capacity. So they're pretty much front-loading it. So maybe within 1 to 2 years, they can potentially start to either maintain capex or potentially reduce capex if they decide to. And they can do it overnight. And Amazon would still be here, and Google would still be here, and Meta and WhatsApp and all their businesses would still be here. So a lot of it is overblown. Now, the narrative, or I should say the second concern, is that those companies are transitioning from capital light to capital intensive, even though, again, they're spending the capex by choice because they're seeing the opportunity. And I don't want to own those stocks if they don't invest when they see an opportunity, But let's assume this is true, that because they're transitioning to a capex heavy business model, that means those stocks will get a re-rating and they're not going to trade at the multiple that they were trading at before. This is 100% fair. But my thesis thesis is the re-rating has already happened. If you look at Microsoft, the stock was trading at 35 times forward earnings. Today, you could buy it for 22 times. Don't you think the re-rating has already happened? To me, it did happen. It's not going to trade at 15 times or 12 times earnings or 10 times earnings. The company would be buying back so much stock. It would be absolutely ridiculous. So I think the re-rating with Meta trading at 21 times, with Microsoft trading at 22 times, Google at 27, you could say still has some ways to go. But most of those stocks, in my opinion, have already re-rated. A lot of it is getting priced into those stocks. That's why those stocks are going down. And that's why I'm buying them. And that's why I'm not too concerned over the next 3, 4, 5 years in terms of the potential returns of those stocks. And I'm going to show you a valuation model or a calculation that I did that helps me kind of be a little bit more confident that my assessment is going to be right. Okay, now this is an example with Meta, which is a stock that I own, and you can do the same thing with Google. You could also do the same thing with Microsoft. Okay, now Meta very recently has been growing in earnings and in revenues over 20% for the last few quarters. Okay, over 20%. Now this table assumes 15% earnings per share growth for the next 5 years, and the second table assumes 20% earnings per share growth over the next 5 years. Okay, very fair. And we assume that the current PE of 21 times is the starting PE because Meta is trading at 21 times, and we assume the share price remains flat over the next 5 years. The stock doesn't go up, it doesn't go down. Based on 15% earnings per share growth, Meta right now is trading at 21 times. Next year, or in 2027, it would be trading at 18 times. The following year, it would be trading at 15 times, 13 times, 12 times, 10 times earnings. So if Meta, people believe the stock is not going to go up because of high capex, if it doesn't go up, and if they keep growing at least 15%, which I believe is highly achievable, the stock would be trading at 10 times earnings 5 years from now. Do you believe this is likely going to happen? I think it's highly unlikely. If you look at 20%, which could also happen, it would be 17.5 times next year, 14 times, 12 times, 10 times, and 8.5 times earnings for Meta 5 years from now, if people believe, and it happens, that the stock doesn't go up because of high capex. Do you believe this is likely? Just common sense. I think this is highly unlikely, which is why I own Meta, I own Microsoft, I own Amazon, and no one hates big tech more than I do. I've never owned them, and you could say I missed out a little bit by not owning them, although I did really well with small caps and micro caps and mid cap kind of hated value investments that I did before. But I'm seeing a clear opportunity here, and no matter how I'm putting it, I'm not seeing how I'm going to lose a lot of money with those stocks over the next 5 years. In fact, I'm seeing a very high likelihood that I'm going to at least double my money and potentially much, much more, because I've been watching those stocks for a while and the sentiment swings all over the place. So first, the sentiment is mostly extremely optimistic, and people look at those big tech stocks last year or year before. They say, oh, I was picking all these stocks, I was picking the index, and why did I pick the index? Why did I pick all those crazy stocks and Netflix and all of them if I could just spot the big tech stocks and did really well? This is kind of what people start saying when those stocks are going up. Once they start going down, which happened once every 2 to 3 years, happened in 2022, you rarely get this opportunity. You could just look at the multiple of Microsoft. It's trading at its 2022 low, trading at 2018 low. And once they go down, people believe that maybe they're just too expensive. Maybe it's capex. Maybe it's the fact that passive investing is going to decline. I've heard all kind of stories over the years. And if you bought them, you did really well. And then once they start going up, people start learning the lesson of, oh, I'm so dumb. Why didn't I buy the big stocks? Why did I pick all these other crazy stocks? And it's just a never-ending, cycle. And I believe it's the same thing this time around, and that's why I'm doing what I'm doing. And I hope you enjoyed it. Hope you got some value. If you agree with me, disagree with me, let me know down in the comments. And it was not financial advice. So thank you again for watching, and I'll talk to you in another video.